You've been telling us all year that retail investors would be better off in cash, and you were right. Even with the rate of inflation, cash has certainly preserved its value more so than the broader markets. But if you have a longer time horizon now, is now a good time to start nibbling, especially at some of those tech names? We just saw Mike break it down, how we are getting closer to those pre-pandemic peak. What do you think?
Well, there's the long term and the short term. In the short term, I actually believe October will end up being up. And the reason I say that is if you look at it historically, October is up 60% of the time over the last 70 years. Average gain is 1%. But when you go into October with the market down 15% in the prior 9 months, your odds of it being up go up to about 83%, and your average gain is about 3%. And even if you look at so far this month, right, horrible PPI numbers, ugly pre-announcements, and the market's down about 1% so far in October. So you're sort of setting up, and even if you look at some of the action today, Applied Materials, big negative pre-announcement, stock's actually up on the day. You look at Micron Technology, they cut the forward EPS from like 70 cents to like 10 cents for next year. FedEx, right, massive pre-announcement. EPS goes down by about almost 50% for the next quarter. Nike numbers go down over 20% looking forward. All those stocks are up 6 to 9% from their lows a few weeks ago. So I think this is all signs that in the very, very short term, my belief is that the market rallies. From the long-term perspective, though, as in the tweet I put out this morning, the bottom, I think, is still S&P 3000, which is a 15 multiple on a $200 EPS. So unless you're willing to trade this market on a daily basis and willing to go to cash, willing to short, you should just stay in cash because 3,000 on the S&P is still a lot lower than where we are today.
All right. So, Dan, you're essentially saying that even if we see a rise in October, that could be another head fake like we saw in the summer. You painted sort of some of the negative data points that we got, but there was a little bit of optimism in today's earnings numbers. You got Delta fuel costs down quarter over quarter. Fastenal spot prices for many inputs began to decline. I think I know what you're going to say, though, and this is acute. You point to the fact that energy and supply chain only accounts for 10% of corporate costs. Wages are worth a lot more. So when do we start to see that? Are you waiting for wages to come down to sort of any sign of a bottom?
You're exactly right, Deirdre. So energy is about 10% of corporate costs, supply chains another 10%. But wages is 2/3 of corporate costs. And if you look at what determines wages, it's really simple. How many jobs are available? How many people are unemployed? If you look at that, you've got about 10.1 million job openings, and you've got about 5.8 million people unemployed. So you've got 70% more jobs than you have people unemployed. The prior record, as far as we have data, is about 25% more jobs. So you're going to need much more pressure on the employment picture to get that down to a level where you get wages under control, because it's great looking at gasoline prices or used car prices and all this stuff. But at the end of the day, the U.S. economy is 75% services-based, and wages is the biggest component of that. And rents, by the way, is the other big piece of inflation, which is 30 to 40%. And that typically peaks out a year and change after home prices peak out, and they just peaked out in March. So you can expect pressure on rents through March of next year. So that's why we have a very big picture view that inflation is going to remain, it's going to come down, but it's going to remain higher than everybody wants through into next year.
Hey, well, Dan, first I want to point out to everybody the Dow has climbed back to almost flat from that dramatically low open. The S&P down 0.5%. The NASDAQ still off by about 1%. But what you said about October and the possibility it ends higher, what does that mean for what we should expect out of earnings season then? Because we're going to get guidance, at least from some folks, for Q4. The dollar has remained pretty strong. How bullish are they going to have to sound in the guide, despite what's happened with inventories, how much they're going to have to comment on discounting and overall weakening consumer demand?
They're going to sound absolutely horrible, John. And I think that's actually what you need. As I said earlier, right, Micron, Nike, FedEx, those are about as ugly forward-looking numbers as you can get. Applied Materials last night, on their negative pre-announcement. So to some degree, this is going to be what's happened already this year. You've had 6 rallies in the S&P this year that averaged 9% apiece. You're not up 50% this year, right? You're down 25%, but those rallies all occurred for the same reason. Numbers get cut. Investors mistakenly think, oh, this is the bottom, not a bottom. Then they run them up thinking, oh, well, this is a great company. Let me buy NVIDIA or AMD or Tesla, or you pick your favorite great company. And I'm not arguing they aren't great companies. But the problem is if the numbers have to keep coming down, they rally for a couple of months, like June to August. If you remember, the S&P was up 17%. And now you've given it all back because numbers continue to come lower. So that's all we're saying is bear market rallies, and we have this on our site, danniles.com, where we've gone back and analyzed them. They happen all the time, right? You had 5 rallies between 18 to 21% in the S&P during the global financial crisis and during the tech bubble break on your way to losing 49 to 57% of your money. So this is pretty typical. So I think in some ways it's counterintuitive, but the worse the guidance is, the more likely the market is going to mistakenly have another bear market rally. And then you're going to figure out the numbers are still too high when we get to the end of the fourth quarter, and we're going to be back in the soup again. But I think that's how you want to think about this.
Right. Hey, Dan, you know, as we pay attention, I mean, before CPI this morning, the discussion was largely about UK, right, and their U-turn if we get that. If there is a dramatic stability event, even if we're not quite back to 3K yet, is that when you start jumping in more aggressively? I mean, I always think back to the depths of COVID when Disney shut the parks, and that's when you got long.
You have a great memory, Carl. Yes, actually, the first thing I look at when I wake up in the morning is typically I look at where credit default swaps are on Credit Suisse, Deutsche Bank, what the 10-year is doing in the UK, not in the US. And those are the things I sort of look at because the tail risk in my mind is another Lehman type moment, which is I firmly believe you're going to get some kind of big financial institution in big trouble. I don't think it's going to be one of the big banks, but I could see another Archegos type of situation because so many hedge funds, 60-40 funds, parity funds, whatever you want to call them, they've gotten murdered on their bond positions and gotten crushed on their stock positions. So I think you could see something like that. So that's the tail risk. But, there's a lot of other stuff like what's going on in the UK that I'm watching. And Credit Suisse and Deutsche Bank are up this morning. So that's a pretty positive sign as well. So there's the very, very short term where I think it bounces. And, I sent you those notes last night saying, that's what we thought would happen. And then there's the long term. And the long term is what you want to remain deadly focused on because the Fed's nowhere near finished. And you may get some short term optimism, but you want to be defensive if you're going to be in stuff. So, we own Walmart because they were up 18% in 2008 with the market down 38. We're in healthcare, another defensive space. The stuff that isn't defensive, we're getting clobbered in, but we think there's going to be a short-term rally that we're playing for.
Dan, even before this morning's CPI number, there's been concern building, even among Fed policymakers, that the Fed could overshoot, something could crack or even break. And I guess, is that what you're saying? Does that risk increase after this morning's number and the prospect that the Fed can't stop doing what it's doing?
Well, you have to remember, Deirdre, it's how you look at overshoot. They undershot, right? They were a year late in raising rates. They massively screwed this up. So they've got to play catch up because the problem here is that inflation hits the segment of the society that can least afford it, right? 35% of people don't own homes. So they didn't benefit from the COVID price inflation in home prices. 45% of people don't own stocks. They didn't benefit from all that massive stimulus pumping up meme stocks in the stock market and everything else, crypto. So the Fed has to focus on those people and not people who can afford to invest or own their own homes. And that's what they should have been focused on over a year ago. So I think, that's just going to keep the pressure on things for longer than what, the average investor wants to believe.
It's a tricky market. Dan, thanks so much for being with us. Always great to get your insights. Dan Niles, Satori Fund.
Thank you.